This is Lam Research's stock through early 2026. Shares doubled, reaching an all-time high of $433.33 on June 30th. Over the next 2 weeks, the stock cratered, losing 20% in days, even as the CFO called demand the strongest of his career. Lam hadn't missed a single earnings target. They just reported the strongest financial quarter and forward guidance in the company's history. Record-breaking profits and a raised outlook typically invite investors in, yet this report triggered a retreat that wiped out billions in market cap. To understand why the market turned on a company at its financial peak, we have to look at the specialized invisible machinery Lam builds and how that technology dictates their cash flow. On Wall Street, a flawless earnings report can serve as a trailing indicator, where record profits mask structural risks about to hit the bottom line. Lam Research does not fabricate microchips. Instead, they engineer the multi-million-dollar machines required to make them. Modern 3D chip making relies on two incredibly difficult steps. First is deposition, stacking ultra-thin layers of materials, like copper and tungsten, with atomic precision. The second is etch. Specialized machines must carve deep trenches and vertical patterns into the material without disturbing the surrounding architecture. Today, Lam is the undisputed market leader in etch and a strong second in deposition. While competitors like Applied Materials and Tokyo Electron operate as broad suppliers for nearly every stage of the factory floor, Lam maintains a hyper-focus on these two specific steps. This focus has built a high-margin monopoly with over $20 billion in revenue, but it also leaves the company's fate entirely tethered to the volatile memory chip market. Roughly 62% of revenue is driven by systems, the direct sale of manufacturing hardware. The remaining 38% comes from customer support. This recurring revenue stream provides spares, upgrades, and maintenance for thousands of Lam machines already in the field. Hardware sales are notoriously unstable. In fiscal 2024, systems revenue dropped 14.5% as manufacturers pulled back, only to surge 23.7% in fiscal 2025 as demand returned. By the third quarter of 2026, Lam reached record levels, reporting $5.84 billion in revenue and a 49.8% gross margin. This high-margin service annuity provides the only financial cushion that allows Lam to survive the boom and bust cycles inherent to their hardware business. This brings us to why the stock dropped. In the semiconductor equipment market, perfect quarters often signal a cyclical peak. Investors assume that once every factory is full of new machines, the next move for orders is down. Geographic risk is also intensifying. China currently accounts for 34% of Lam's total revenue. Export controls and trade restrictions have already cost the company roughly $200 million in lost sales. Investors are betting that this geographic vulnerability will continue to materialize. Then there is customer concentration. Lam relies on a small group of giants, Micron, Samsung, SK Hynix, and TSMC, to drive the bulk of their hardware sales. While AI and high-bandwidth memory currently drive a gold rush, any saturation in AI infrastructure would lead these manufacturers to stop ordering new Lam machines immediately. Lam's 20% drop after a record order reflects a market pricing in future headwinds rather than celebrating current success. Investors weighed these historic numbers against clear macroeconomic risks and bet that the company had finally hit its cyclical ceiling.